Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, a week full of central bank intervention, officials attempting to preserve financial stability, the inflation data pushing them to keep on hiking. We begin with the big issue, policy in conflict.
This tension between monetary policy and financial stability.
There's definitely a tension there, to put it mildly.
You're printing money by buying long-end bonds while you're tightening interest rates.
These two things are in conflict.
It's like having a foot on the brake and a foot on the accelerator.
We learned a lot.
It's about time frames.
We learned that you can get a major policy slippage in the G7 countries.
Contradictory things coming out of fiscal and monetary authorities.
We've learned that liquidity can evaporate in mature markets just like that.
The book says calm nerves, be stable.
Manage a short-term pressure and then move back to a long-term objective.
But none of that has happened.
And we're kind of in a mess now.
We're seeing, the economics of pandemonium.
It's been very sobering and we all feel exhausted.
After the week we've had, I feel like I should provide therapy to people in the fixed income market, but I'm not here for that. Subadra Rajappa joins us now from SocGen, PGIM's Greg Peters, Lotfi Karoui of Goldman Sachs. Subadra, first to you. I guess this is a big question for us now. Can you address financial stability and tackle inflation at the same time?
Well, this is proof positive that it's actually quite challenging to do that, especially in an environment like this where you're seeing just a variety of metrics showing signs of stresses, right? You have poor liquidity in the bond markets. Liquidity has been deteriorating steadily since September of last year when the Fed started tapering asset purchases. You're looking at a dollar that's extraordinarily strong. You're looking at the cross-currency basis that's starting to widen. You're looking at bond volatility at historical highs. I mean, the MOVE index is at 140. It's rarely at that level in the last 2 decades, and then we've touched that level many times just this year. And this is all happening at a time when global inflation is rising quite dramatically and global central banks are tightening monetary policy. So it's going to get extraordinarily tricky from here on.
Greg, how do we resolve this policy conflict?
Well, I mean, the Bank of England is in an impossible spot here. They're backing to the corner. They have to deal with, the fiscal policy that was delivered to them. The real question on the table, though, Jonathan, is whether this is a roadmap to other countries and other kind of response functions by central banks. I don't think it is. It's an open question, of course, but the markets are really trying to figure out if the roadmap of central banks having to step in, to make up for the fiscal, what is that kind of how it's going to be going forward?
Lotfi, your thoughts on what Greg just said. Greg, I want to jump in because that piece of it I think is really, really important. Lotfi, what we've seen in the UK this week, could that become something like that, the new normal for other central banks, other regions?
Well, hopefully not. I don't think you see like 200 basis point round trips in real yields every day. Look, the last thing you want is for the macro pressure to sort of morph into a problem for financial stability. So from that perspective, I think what the BOE did is definitely a welcome development. I would take things one step at a time. I do agree with Greg that this is an incredibly challenging and difficult equation to solve. Can it become a playbook in other jurisdictions? I would keep an eye on Europe. I think in a very different setup, the ECB is somewhat facing a similar tension here, which is manage the left tail risk of the distribution, and we'll see what happens with the Italian budget in upcoming weeks, while at the same time continue to deliver the tightening in financial conditions that is required to gain back control on the inflation narrative.
Lotfi, you nailed it. I think the ECB was the first to go here with that TPI program. They had to come up with a mechanism to contain yields before they even started hiking interest rates. They're going to go again. They've got the mechanism. Let's see if they actually use it. BOJ's had to intervene. The ECB set up a vehicle to deal with what's happening in the bond market. The Chinese are threatening to intervene. We've seen the intervention from the Bank of England. Lotfi, I'm sitting here just wondering, who's next? And is the Fed going to come into play?
Very high bar in our view. We do expect them to stay the course, deliver 75 basis points of hikes, in the next meeting. I think, when I think about sort of the central bank's reaction function, the Fed is probably the one central bank where the bar is really high, partly because, there's still a ton of good momentum in the economy. The risk of an imminent recession is very low, and I think that will dictate a reaction function that is still very much skewed to upside surprises in inflation.
Greg, what's your take on that?
No, I completely agree. I think the bar is really high for the Fed. I think the markets are misreading the Fed and have misread the Fed all along. The Fed continues to push back. They're doing it today as well. So I think, you've been in this environment where traders and investors in the U.S. have kind of summarily dismissed what the Fed has been saying all along, and it's finally been catching up since Jackson Hole. I think that's going to continue. So I don't see what's happening in the UK as something that is a concern here at this point in time. So I think it's way too early for this global central bank pivot trade that some are latching onto. I think that's somewhat of a farce.
Subadra, one thing we talked about through much of this year, there's a choice here, either a recession or high inflation, and you've got to pick one, pick your poison. I just wonder, is it a choice now between recession and financial instability or higher inflation for longer? Is that where we're at now? Is that the decision these central banks have to make?
Absolutely. I think there's a third wheel to this. It's not just inflation or recession. It's also financial stability. I mean, to the discussion we were having earlier, the one thing that I'm concerned about for the Fed is the lack of liquidity in the Treasury market and the choppy price action that you're seeing in Treasuries. Let's not forget that back in March of 2020, when the Fed engaged in QE, it was because liquidity in the bond market was starting to dry up. I'm not saying that we'll see a repeat of the same scenario again, but that's something that I'm closely watching because liquidity metrics have declined. And like I pointed out earlier, there's a whole bunch of other variables that could potentially lead to financial stability. And that's where I think the balancing act for policy gets very, very tricky. For the near term, I agree with Greg. I mean, they're going to be much more focused on raising rates and focusing on bringing down inflation. But they are going to have to deal with financial stability issues as they go along.
Subadra, push that through the yield curve. Your call right now, in your notes, I'm reading them. We retain a bearish bias and expect yield curves to remain inverted. Just fold in this discussion into that call.
So the front end, of course, is very much pegged to Fed expectations. The Fed has told us that they're going to be delivering about 125, 150 basis points of hikes for this year. So the front end is going to reflect that momentum that the Fed has communicated very clearly to the market. But on the back end, it's much more a situation of what's happening in growth. I think if recession fears start to rise, you're going to see that being played out in back end yields. Back end yields are going to rally a lot more. So we're going to see much more inverted curves in this cycle than in any of the prior cycles that we're familiar with in the past 2 decades because of the fact that global recession fears are starting to rise quite meaningfully as central banks globally start to raise policy rates.
The range on treasuries this week on a 10-year, the high was 4.01%, through 4% early this week. The low was 3.67. So quite a range on a 10-year treasury this week, and seemingly a struggle still, Greg, to know how to price this. Growth is screaming to send yields lower, and at the same time, inflation is arguing for high yields. What wins out there, Greg?
Well, so the interesting aspect of that, Jonathan, is that forward inflation expectations have dropped, right? So the market is telling the fixed income market, rightly or wrongly, telling you that inflation is not a problem down the road, and it is transitory, to borrow a phrase. So that's the conflict in the market. The market is giving the Fed and central bankers a lot of room to maneuver here on a forward basis. If that changes, then I think the whole backdrop changes. So that's the thing we're focused on, much more what the forward markets are telling you around inflation expectations, and that's dropping, not rising. And I think that gives a lot of credence and comfort to central bankers.
I can tell you the equity strategists are now starting to dabble in fixed income. I've had guests come on the morning programme with me and talk up the prospect of bonds starting to behave well. Lotfi, I just wonder whether you think the bond market is going to start behaving in that way that it typically does, whether we get back to that world where it starts to provide us with some risk-mitigating characteristics, whether we can break this correlation between risk and the risk-free asset.
I mean, you definitely have the best level of yield support you've had in 15 years at least. And so mechanically, yes, I do think that you have a much better buffer if you think about a 60-40 type of portfolio here. Now, in terms of sort of the direction of yields, you know, we're probably the closest to neutral we've been in quite some time, even though we do have a little bit of a short bias, at least on the margin. There's a lot that is priced in at the very front end, so the risk is a lot more balanced there. And then to add duration, you really need to think about the value proposition of cash here. It feels a little premature to ask, particularly given where the risk of an imminent recession is today, which is fairly low. And so I think for the time being, cash sort of remains king. But to answer your question, yeah, you do have a better buffer today, no question.
Lotfi, we'll talk about the credit market in just a moment. Lotfi Karoui is going to stick with us alongside Greg Peters and Subadra Rajappa. Coming up on this programme, up next, the auction block. Another week, another one of volatility keeping borrowers on the sidelines. That conversation up next. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe. The primary market missing weekly estimates yet again, with Friday recording the 39th day without a single debt sale this year. Another slow week for US high-grade debt issuance. September volume finishing nearly 50% below monthly estimates. And a group of banks scrapping a roughly $4 billion debt offering Thursday, failing to find sufficient demand after a disappointing Citrix deal just last week. Sticking with credit, JP Morgan's Kelsey Barrow playing it safe.
We are remaining defensive. We're staying short duration, and where we are allocating money, it's to high quality, short dated investment grade. Also in the securitized space, when you think about auto loans, for instance, or consumer loans, people are still employed. People are still getting jobs, which means they're still able to pay their bills.
Lotfi Karoui, your words. Assuming this year's move higher in yields persists for years to come, corporate borrowers could essentially face the largest shock to their cost of capital in more than 3 decades. Lotfi, just what are we upending here? I've thought more and more about this. A decade of zero interest rates, in some places negative rates, tons, trillions of QE, negative interest rates in the bond market. What are we upending here?
Yeah, I mean, look, if yields don't mean revert to where they were pre-pandemic, I do think that, yeah, you'll have to transition towards a new regime. And that regime is probably permanently higher cost of capital. I think it means an adjustment for leverage balance sheets. The good news is that if I look at high yield bond issuers, we do have time a little bit. There's very low refinancing needs in the near term, but you're sort of back where you were in the 2000s and possibly the mid 90s. And so coverage ratios are going to come down quite dramatically. It's mechanical. There's nothing magic about that. And then more importantly, I think investors' tolerance vis-a-vis leverage balance sheets is going to go down quite dramatically because it's going to cost a lot more to issue.
Greg, what vulnerabilities do you think this shift is going to expose?
I just think that the overall leverage, I mean, it's a simple story ultimately, right? Corporate America broadly has added a lot more leverage over the past decade because they were kind of hyped up on low interest rates. So there's a tremendous amount of operating leverage built into these capital structures. So that works great when revenues and profits are moving in a positive way. The opposite's true. So I think there's a kind of a lot more kind of leverage on the come that's not being anticipated. And then honestly, you haven't seen a cleansing across sectors or within the system for a very long time. So I think ultimately that excess capacity has to get cleared out. And so my strong suspicion is that this credit cycle is going to be a little longer and harder than what many are forecasting.
Lotfi, do you agree with that?
I have sympathy with that. I think there's definitely some pockets in the leverage finance market where the balance sheets are a lot more rate sensitive. So leverage loan market is a good example. 80% of the universe of leverage loan issuers today are actually loan-only capital structures. So they rely entirely on the leverage loan market for their financing needs. Think of it this way. Every jumbo hike that is delivered by the Fed translates instantaneously into a higher running coupon for these companies. So there's definitely pockets in the market where the risk of call it a mini payment shock is somewhat elevated.
Listen to this conversation, the outlook for growth, the risk in the credit market, high yield spreads. Subadra, high yield spreads 561 basis points. Our conversation seems extremely pessimistic. The pricing in the credit market, less so, Subadra. Why do you think that is?
Because of the fact that you're getting pretty decent returns for at least some of the better names by investing in bonds, right? Especially in the Treasury market, 10-year yields start getting towards 4%. Returns start looking quite attractive to investors, broadly speaking. So I don't see, you could see that as being some sort of a near-term cap on at least Treasury bond yields over the near term. For the credit markets, it's much more nuanced. I think that the quality of the credit matters a lot more. And as we head into a recession, I think that there's probably a little bit more concerns on both high yield and credit spreads in general widening as we head towards the recession. So I'd be a little bit more cautious on sort of risky assets than riskless assets here.
Greg, this is the piece I wanted to pick up on, the recession risk. If you ask someone if the Fed's going to stop hiking in a recession, is that bullish? They might say yes. If you ask them if the Fed isn't cutting in a recession, is that bullish? Same thing, you might get a different answer. Greg, I just wonder what happens when we realize that this Fed might not be cutting interest rates in a recession.
Well, I think that, I think that's kind of the pain scenario for investors writ large. And essentially, that's what the Fed's telling you, right, if you listen closely enough. But to Subadra's point, I think there's a big divide between risk-free, let's say, treasuries versus credit. And so if you think about that scenario of a recession, all else equal, whether the Fed's pausing or cutting, you want to own duration, you want to own U.S. treasuries. You can't say the same for credit. So the way we're thinking about it at PGIM Fixed Income is the sequencing. You want to own duration first, get through the tough parts, and then get into credit.
I think duration right now is the difficult piece of it, and that's kind of where I wanted to finish with all three of you. How do you price risk, Lotfi, when the risk is in the risk-free asset? We've seen that play out in gilts. We've seen wild swings in treasuries. How do you price risk when the risk is in the risk-free asset?
So again, I think I'll sort of come back to where we started the conversation. I don't think the UK playbook is something that we should apply to other jurisdictions, but how do you price it? I think you stay up in quality, you stay up in liquidity too, because of all the sort of microstructural challenges that we discussed here. That's sort of at a high level how I would look at it.
Greg, your take on that?
Yeah, I agree. I mean, as pessimistic as this program is, I'm probably more excited about the opportunity set in a very long time. The market's extremely dislocated. You're seeing high-quality assets trading really quite cheaply. I think people are conflating financial stability risk with just good old-fashioned volatility and markets moving lower. So it's high quality. The market is affording you the opportunity. Take advantage of it. Don't get induced to high-risk assets.
Does that include a 10-year at 375, Greg?
That's closer. I mean, I'm not willing to claim that that's the top, but you're a heck of a lot closer now than when you were at 50 basis points, to state the obvious. So I think we're getting closer and getting more excited about it.
Subadra, you getting excited about 374?
No, I think we have our year-end forecast for 4% in 10s. If you get close to that level or even higher, I think that would be a buying opportunity. If you think about it in terms of where you would be wanting to put your money in at the end of the year when the Fed is very close to its terminal Fed funds rate, then it's going to have to be treasuries first and then risky assets later.
Don't blame me for the tone of this programme. The three of you are the ones that make up the tone. I'm just here asking questions. Say what you like. Greg Peters, Lotfi Karoui, Subadra Rajappa, sticking with us. I haven't done this programme for about a month. Still ahead, the final spread, the week ahead, featuring the US payrolls report and another busy slate of Fed speak. You can't wait, can you? That conversation, I'm next. Live from New York, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, another busy slate of Fed speak due next week with Bostic and Williams on Monday, plus more from Mester Daly, Evans and Waller throughout the week. We get PMIs and retail sales out of the Eurozone, initial jobless claims coming on Thursday, and rounding out the week with the US payrolls report on Friday. I can tell you right now the estimate so far in our survey, and we'll update that over the next week or so, is 250K, the previous read 315. Back with us, Subadra Rajappa, Rajappa, Greg Peters, Lotfi, Karoui. I wanted to come to you quickly, Subadra, just on the jobs report. A line that stuck with me this week: you can't fire what you couldn't hire. And I just wonder, given how big job openings have been, whether that dramatic deterioration people are looking for in the labour market as we approach some economic weakness, whether it shows up anytime soon.
It just might not. I mean, you're looking at initial jobless claims for the last several weeks. It's been trending lower. We're expecting maybe 200 to 250,000 jobs to be created next week when we get the unemployment report. So the job market's extraordinarily robust. So what you might start seeing, initially is the jobless, sort of the JOLS job openings. Those might come down. People might just stop hiring. But I think we're still ways away from starting to see en masse layoffs. And that's why I think a gradual rise in the unemployment rate makes a lot more sense. I mean, the Fed has 4.4% penciled in for next year. That is quite a dramatic move for around 3.7% this year. But if we do get there, then we're looking at a meaningful slowdown in the economy and perhaps even a recession.
One thing we know is this cycle has moved really, really quickly. I said 250K was the estimate on payrolls, 3.7 the estimate on unemployment, 3.7% the previous read as well. I want to get to the rapid fire round. 3 quick questions, 3 quick answers. Earlier this week, 4% on a 10-year yield. 4% on a 10-year this week. The higher the week, the higher the year. Greg Peters, is that going to be the high of the year when we get to year end? Yes or no?
No.
Subadra?
No.
Lotfi?
Yes.
When we get to 2023, is the Fed still doing QT? When we get to 2023, is the Fed still doing QT? Yes or no? Lotfi?
Yes.
Subadra?
Yes.
Greg?
Yep.
Final question on the Bank of England. Scheduled meeting November 3rd. Can the Bank of England wait until November 3rd to hike rates? Just a quick yes or no. Subadra Rajappa.
Yes.
Greg Peters.
Yes.
Lotfi Karoui.
Yes.
To the 3 of you, thank you. That was good. It wasn't that depressing, guys. We appreciate it. Thanks for staying late on a Friday afternoon. Subadra, Greg Peters, Lotfi Karoui. To the 3 of you, thank you very much. From New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.